Capital markets are very nervous. Investors shuddered at the reverse oil shock. Let's not forget, oil dropped by over 60% over the last 4 months. And it's not only about oil. We have seen also copper coming down quite sizably this year by over 8%. So what we would like to highlight here, what are the events which would make change us in our investment strategy? Global growth could basically derail. And what we mean by that, especially the growth in the US could derail. So dropping earnings per share and rising fixed income could lead to a global sell-off in capital markets. But it's not only about the US, we should also contemplate Europe. Anybody who looks at Europe has realized that in the fourth quarter, economic growth basically stalled in Europe. And if we look at Japan, which is the fourth largest economy, we have seen that Japan is actually in a recession. The future of the Eurozone might be jeopardized. First, the ECB might be behind the curve, and actually Europe would have deflation and very limited growth, which would lead to countries wondering what are they doing in the Eurozone. We already see actually an election in Greece, which upsets many people in Europe. But it's also about right-wing parties. They might gain more and more track in the relevant countries. And last but not least, if the ECB is not being backed by Germany, then we have definitely a very fundamental issue in Europe. There might be a lot of other risks, such as geopolitical risks and events. Clearly, we look at the Islamic State, we can speak about Syria, we can speak about Russia and the Ukraine, and that all is very hard to predict. But if any of those events would have an impact on global economies or commodity prices, we need to take that into consideration in our investment strategy. Many people have expected to see a hard landing in China. This is not something new. Market observers speak about a Chinese hard landing for the last 6 years. Now, what we have seen this time in China, that in the 60 benchmark cities, property prices have come down. It is important to understand that the Chinese administration, they actually finance themselves by selling properties. This might have an impact on the overall Chinese economy and on the infrastructure investments in China. So a hard landing, meaning a growth below 5%, meaning an increase in unemployment, and probably problems for the administration, must be considered. There's actually also some upside risk coming from US economic growth. If the growth is too strong, what we could see is a disorderly sell-off of treasuries. Now, let's not forget, treasuries are a safe asset. Nobody expects to lose money on treasuries. So this could have a huge impact, not only on investors, private investors, but also on financial institutions. And that is something which we simply cannot ignore. The wall of worries which we have described here is very real. Volatility definitely will increase this year. And the only way to face that is by having a highly diversified portfolio. Let me remind you that we at Bil, we invest for our clients into over 12 different asset classes. We are happy to take on this challenge for you.